Welcome back. My name is Chris Gosselin from Australian Fund Monitors. Welcome to today's video ahead of the Reserve Bank's board meeting next Tuesday. Markets are widely expecting the RBA to cut rates from the current level of 3.85%. So we've invited back two guests with a proven track record for getting it right. Before the last meeting in July, when the consensus was firmly behind a rate cut, both Nicholas Chaplin from Seed Funds Management and Renny Ellis from Arculus Funds Management correctly predicted the RBA would hold steady. They were spot on. They were also absolutely flowing against or going against the general market expectations. So today we're joined again by Nick and Renny to get their insights in what might happen next Tuesday. What's driving the RBA's thinking, and what a potential rate cut, possibly even another hold, but we doubt it, could mean for markets and investors. Gentlemen, welcome back.
Morning.
Thank you, Chris.
Last time we spoke in July, both of you called it right when you said the RBA would keep rates on hold despite those strong expectations for a cut. What was it in the data or the RBA's thinking that led you to that call? Renny, can we start with you?
We have an economy where we're operating beyond full employment. Unemployment is well below the RBA's measure of full employment, which previously has been at 4.75, but even if we bring it down to 4.25, we're still operating at full employment. And we're doing so at a time when fiscal expenditure is still rising, deficits are still expanding. So there is a fiscal backstop or wind behind the economy as well. Yes, inflation has come down, but the RBA stated many times that it was going to look through the electricity subsidies, and I believe that's still the case. That it's come back down towards target, but they're going to wait and see here and give it some time.
So, Nick, what's your view on that? I mean, again, you correctly predicted that the RBA would hold last time. Do you think those conditions still remain?
I think they do. I think there's the way I see it is even with it in target, and I think Rennie's points around the subsidies that have been provided to consumers, it's real, it's true, and that they are having an impact. You still end up with unemployment having even gone from 4.1 to 4.3, it's historically on the low side. So I feel the RBA is actually in a neutral stance, or could consider themselves at a neutral position where both of those outcomes are sitting within bands that they'd be comfortable with, not necessarily triggering a move up or down. I think the interesting thing that's perhaps a little different to a few weeks ago, and noting that the next meeting's not till the last day, or the next decision after next week won't be till the end of September. So you've got longer time to play with now, more information to come in, but it's not 5 weeks. It's more like 6 or 7 weeks. So you've got to be thinking about things like consumer confidence. There was certainly some cautious pessimism displayed by the recent Westpac Melbourne Institute outcomes below 100, which is neutral. It's about 92.5. You've also got that little lift in unemployment, and some redundancy news is starting to flow through. So it's a little different from last time, but I would still broadly categorise the RBA's position as neutral at the moment.
Could I just take up a couple of those points, Nick? The RBA in the May monetary policy statement, we're looking for inflation in the June quarter to come in at 2.6. So it's come in slightly higher than at 2.7. So I don't believe they have a reason on inflation to move. They have got some very good, both at the RBA, probably the best around, but also in Ian Harper and now Renee Fry-McGibbon, on people that do proper economic modelling. And they will have been cutting rates back in February and May with a view that this would be the inflation result we got in June. But looking forward, they may be looking at those subsidies coming off and saying, well, inflation is definitely going to rise. Just on the unemployment data, I didn't view the unemployment data as really meaning anything because it was judged stronger than expected in May for seasonal differences, and then it was really weaker than expected in June for seasonal reasons. But broadly speaking, I just don't think unemployment really moved very much. When we talk about retail sales and vehicle sales and consumer confidence, they are broadly where they were prior to the pandemic, back to those sort of levels. But it does take time for an interest rate cut to come through. There's lags in flowing through to household activity. So I would give it 6 to 9 months from the interest rate cuts that we had starting in February for some sort of impact on household activity. So it maybe from September onwards, we might see some consumer confidence numbers and retail sales numbers showing a little bit more strength.
And one additional point, Chris, just before we go to your next question on the unemployment numbers, and that's the underemployment number, which is an interesting one to watch too, and again tends to pull you in the direction of neutrality. And that is that the most recent was 5.9%, well below what it's been for some years. Underemployment was travelling up near the tens for in the last decade, and now at 5.9, that's comparatively low. So, whether you've got people who are working part-time instead of full-time or working 2 jobs but not filling a 40-hour week, however it's constructed, that number is materially lower than it has been historically. So another one for the mix, I think, Chris.
So it sounds as if, listening to you both, that you're very much steady as she goes, keep rates where they are, but there was widespread outcry, I suppose, from the people who got it wrong last time, particularly the media and the Treasurer, that that they should have cut. Maybe the Treasurer was a bit quieter than normal about it. Maybe he was just not fully voicing his disappointment. But do you think there will be a cut next Tuesday, even though your feeling is that maybe they should be steady as she goes?
I don't believe there's the same level of confidence around this cut that you'd listen to the media. 90-day bank bill swap's still at 3.7. Prior to the last meeting, it was down to 3.58. They were very certain it was going to happen. So I don't believe there's the same level of confidence about it. I think that they should hold and keep something, some firepower there for later in the year. Let's have a look at what the data looks like at the end of September.
Yeah, I think Michelle Bullock made the point. She talked about dry powder at least once in answer to one of the questions post July 20. But, we've got a situation where you can't go back to point 1 easily and leave yourself that exposed to an inability to react from a monetary policy perspective. I thought the reaction from the media was shameful to the decision last month, but typical at the same time. Even some of the questions in the room directly to the governor were incorrectly guided, I thought. She did the right thing. And I'm not saying that just because we both suggested that was the thing to do. I'm doing it because it was the right thing to do. She knew that there was a short period of time to the next decision, and there's a relatively short period of time, if you like, to September 30, and the one after that's in November. On the other hand, I feel that I'm going to stick my neck out and suggest she will drop rates this time. I'm not suggesting at all that she should. I'm a bit of a wait and see as well. And I do think the point that Rennie's made about you need to be able to react when things actually happen. There is a lag effect even from dropping the cash rate target, and it can be quite extensive. And she also made a really good point, which was, again, right at the end of the interview and series of questions, which was, of course, people are complaining about the unaffordability of housing. If the board had reduced rates, that generally forces prices up, which generally makes things less affordable. So she's going to be wrong, according to the media, whether she does or not, I think, Chris.
Okay. Longer term, what's your view on the rate path into 2026, or even for the rest of this year, as you say, September, October, November?
Without an external shock, I see at most one more rate cut in this cycle only.
Yeah, I'd agree with that. I think if it comes tomorrow, it comes on August 12th, on Tuesday, that'll be it for the year. And then it's monitoring for the remainder of the year and into probably February, March next year before. And again, it'd have to take some movement in that unemployment number and some other commentary around redundancies and real moves in unemployment, I feel.
Let's switch to the US. Inflation's been creeping back up. Employment figures have been drastically revised down, prompting some pretty strong criticism and reaction from Donald Trump. How do you interpret what's happening in the US and obviously tariffs, which are now in place and about to start flow through into the US economy?
It is a difficult question, and I think Michelle Bullock said it when she talked about uncertainty from all of this and how things are going to react. In a US context, the tariffs are inflationary. They're definitely inflationary. How inflationary? How much they're inflationary is sort of the million-dollar question. There's been a lot of misreading of data, not just the unemployment data, but the data has been distorted, if you like, by Trump announcing that these tariffs were coming, from January onwards. Businesses built up inventory, then announcing the tariffs, and then saying, "Oh no, now there's a window." So they ran down their inventory again. There wasn't a flow through on prices. So maybe from now on, we're going to start to see the actual impact of these tariffs on inflation. We'll see how much businesses choose to pass through to consumers. I would say though that the weakness in the US dollar, if it remains weak and it doesn't start to rally, then we're going to see an inflationary impact. And if it continues to weaken further, then we're going to see a stronger impact in the United States. So it takes a lot of time for factors of production to move back into the States and start producing these goods if they can produce them, at the same cost. I was a little bit perturbed by the 29% tariff on Vietnam, because Vietnam's comparative advantage is cheap labor. I don't see how the United States overcomes that. They've not got cheap labor. They can't have cheap labor tomorrow. That comparative advantage that Vietnam have isn't going to go away and be replaced by something. Maybe AI might do it. Chris, you're a big fan.
Well, Renny, if you talk about cheap labor in the US, they've exported them all back to various countries in South America. The source of cheap labor, if they have one, is disappearing.
And that's the quandary that came out of that unemployment data and the revisions last week. I mean, the revisions were shocking. 260,000 difference in jobs. But at the same time, labour supply had reduced. So the unemployment level was steady. And so the Federal Reserve there is looking at still a balanced labour market with demand coming back, but supply coming back too.
Nick, do you think there's a risk that the RBA is watching the US too closely? And if they are, should they be?
There's always a risk of that, but at the moment, my sense is that they're not treating it with more focus than they should. I think they're aware of all the factors Rennie's just mentioned. They would also be aware of the fact that the independence of the Fed is important, just as much as the independence of the RBA. I mean, we had GDP numbers coming out at 3%, but obviously there were reasons for that, and it didn't mean automatically that the economy's going great guns, so therefore you simply can't reduce rates. But it was an odd message that was going on in the US, where there was a demand for rates to be dropped, and here you have a headline GDP at 3%, at least temporarily, and due to a bunch of factors, including what's going on with tariffs and the movement in inventories at US businesses. So you've got to watch it and think about it as an independent, massively larger situation in the US, that there are some similarities, but by no means is it going to be dictating what should be done here in Australia. I was interested by your comment about the currency, Renny, because personally I see that the US dollar is too strong at the moment, as opposed to weak. And now I am comparing it to the Australian dollar, particularly at that stage. We're at 65 cents. We should be at 70. I have no reason. I do not understand why the Aussie is still 65 versus the US, particularly when the US is trying to get the value of the US dollar down against other trading partners. We may not be important enough to have that play out here, but it's seen a little bit of weakness in some other currencies, but I think it's got a way to go before Trump's happy, certainly with where the level of the US dollar is. So maybe he's welcoming that ultimate inflationary aspect of the currency.
I'm really looking at it from the point of view that a weaker currency on its own is inflationary. And what helped him last time he introduced tariffs in 2017 was that the US dollar was strengthened, and the impact on the consumer was offset by the increase in the value of the dollar, so the inflationary impact wasn't there. This time round, that if you're saying the US dollar is going to weaken further, and a few other big houses around town are saying that too, then inflation is going higher. It'll accentuate the impact of the tariffs.
Yeah. So to your point, Chris, if Michelle Bullock is paying more than normal attention to the US, that's going to be a key on her mind on the 12th of August, and it could stay her hand again. But there's this enormous pressure on her to reduce rates. It's a more silent pressure than Trump yelling at Powell, but it's very similar.
So finally, if we can just look forward, or currently, how do you position your portfolios given the situation can change so quickly, both here and in the US?
Well, we've definitely tilted to in as much as we are under a fairly hefty constraint on interest rate duration with this fund. We definitely have tilted there. I've done that in the past over the years as well, but this one's played out longer because of the expectations of the government, the expectations of the media for rates to reduce. I thought when CBA and one of the other major banks came out a couple of months ago suggesting there were potentially 4 rate drops after February's rate drop, making 5 for the year, that was way overdone, and I couldn't see where their trend was coming from. And as we've said today, I'd expect if they do reduce on Tuesday by 25, despite the fact if they're going to drop, it should be 35. I thought I'd just get that in, Chris. It will be the only one for the remainder of the year. But I think we'll see what happens. But I think there's scope there for Michelle Bullock to perhaps cause some consternation in the media again.
Okay. Renny, how do you position your portfolio?
I'm happy that I'm disagreeing with Nick on something. This hasn't happened to date. We've been very poor theatre to date. Look, I don't see any point in adding duration at the moment. We're sitting on a 7% yields in portfolios and or in our main portfolio, retail portfolio. I don't see any need to move it. The 5-year to 10-year part of the curve, I don't see it coming down very much further. We might see a small drop in the 1-2 year part of the curve if Nick and I are wrong about the next interest rate cut. But thereafter, I still see the curve, if anything, getting a little bit steeper. And it's a question then of where you add duration to. If the economy does start to weaken and rates start at the long end of the curve starts to drop and it doesn't stay as steep as it is, then credit risk is going to go up. And so, unless you're in a Commonwealth AAA Treasury, we're going to be exposed to an expansion in credit margins. And it's not just going to come at corporate level. The situation in Tasmania and Victoria really is quite serious. Their budget deficits are growing, and their debt profile is growing really without any controls in place.
Gentlemen, thank you. I'm sure we'll all be glued to the screens at 2:30 next Tuesday. And if there's anything contentious there, we might check in again to get your reaction to what the decision has been. And again, to Michelle Bullock's press conference afterwards. We would hope that it's not quite as shallow as it was last time.
I hope so.
Yeah, me too.
Gentlemen, thank you very much indeed. Good to speak to you as always.
Thanks, Chris.
Thank you, Chris.